a factor that we've been watching, multiple factors that coalesce and tell us that we've entered a phase in silver similar to, or almost identical to, the surge that occurred in 79 to 80, and already in a bull market for multiple years, but suddenly in the final 5 months of that, silver quadrupled. Went berserk. Okay, 5 months, just short of 2 quarters. And you go back and look at 2010, in September of 2010, something happened. I'll tell you what it was, technical thing. And in the next 7 months, silver doubled in half. It was like $20, it went to 50. Okay, but all of a sudden, in the latter phase of ongoing bull markets, it wasn't like a new bull market. It just went berserk. Okay, but both of those berserk moves were within that old half-century range where silver was capped off. Gold wasn't capped off during that time, but silver was. Same highs, 2008, 1980 and 2011, same high, whereas gold was, way above the 1980 high. Okay. For some reason, silver was capped. What drives gold historically is money. Okay. Meaning the degradation of paper money units, and therefore gold goes up as they go down. And you look at an M2 chart of the U.S. money supply, and you'll see a exploding, you think, gee, what a great bull market. It goes up 80, 90% a year, meaning it degrades by that much due to the quantity of dollars created. Same with the yen, the euro, a lot of junk paper. Okay. So gold is real money and it holds value. Okay, period. It's done. It ebbs and flows. Yes, that's true. But we're facing right now a global, especially Western world, crisis in fiat currencies, government debt markets. In other words, statism has created things that have been around for multiple decades now and just keep going on and on, creating debt markets. And, Jamie Dimon, for example, said months ago, you can't keep playing this government debt game and just push it off. Finally, you have a problem. Well, the problem this time around with the paper asset side of the equation, stock markets and bond markets, is this isn't like 2000, 2007, where you went into a bear market in stocks based on a dot-com bubble or mortgages. You got government debt crisis. And Japan is, in effect, in flames right now with their government debt. And the new prime minister there, selected, about several quarters ago, she's sort of a Trumper in Japanese politics on that side. And she said, we're going to print. Okay. Well, even the Trumpers are going to print. So everybody's going to print. So the central banks, in order to deal with their own collapsing debt markets, have to defend them. And there's one way to do that. And our Fed, the New York president of the Fed, Williams, New York Fed, said in mid-November that the Fed is going to start buying bonds. And his excuse was...
Tell us what that really means, Michael.
He said, is to provide liquidity to the market, not to support it. Okay. Well, since then, bonds have dropped in price, risen a bit in yields, and they can't seem to get off the floor. They try to rally the price of the futures, meaning yields drop, and they can't get it going. But the Fed's got that floor under it. Well, it's not acting very well. It's sort of eating through the floor even. You have to break that market down, and this has to do with gold, by the way. You ever break that T-bond market, which is trading right now around 114, 115 on the T-bond futures, down much under 112, a couple points below here. No big headline. You're going to start breaking hard because our metrics, our momentum trend metrics say, this holding pattern isn't holding. In which case, we're going to have the same problems Japanese bonds have. Well, we can't take that. That's mortgage failure is just one thing. Government bond in doubt is another. And they're going to print. And we know whether they print now, which they already are doing, but cut rates and print, we know that Trump will have a guy in there that'll do that, to the max. Gold knows that. So gold isn't just going up like it has in past bull markets based on something breaking, the Fed panics about and prints some money. The bubble market, .com broke. So they printed like crazy, started in 2001, all the way down. They cut rates, printed money, it didn't work. Stock market went
Right.
down anyway, gold went up. Or the mortgage thing. This time it's a government debt crisis. We have a crisis like we've never seen. So don't expect this gold bull market to be just another gold bull market. It's likely to be of far bigger dimensions, in particular silver. I don't know,
Okay.
except to say that you're going to get a lot of it between now and the summer. We have reasons for that, particularly in silver, between now and the next 4 months, let's say.
Okay.
But gold, if you go back and look historically at gold since it was legalized in the U.S.,
Yeah.
you've had two prior bull markets. One came from the 1976 low to the 1980 high. And if you
Hmm.
look at that carefully, it was an eightfold move. In other words, if you bought gold, you made 8 times your money in 3.5 years. Okay. Then it corrected and lived in a new higher universe for a couple decades. And then in 2002, it made a low at
Hmm.
$265. And over the
Hmm.
next 10 years, it went up eightfold move.
Hmm.
You bought the bear low, you made 8 times your money. Different dimension in time, but same multiple. Well, our bear market low was 1,050 in December of 2015. And where are we now? Fivefold. We're not even eightfold yet. In other words, gold has yet to do in metrics,
Hmm.
ratio, scale, move, what it's already done twice before. You'd have to go to $8,500 gold. And then when you get there, you'd say, well, it's got to be it's only matching
Hmm.
the, the bull trends that it had before in terms of dimensionality. So that would be a norm. So you say,
Yeah.
where's gold going? I'd say, if it goes to a norm, it'll go to 8,500. But we're in a different world this time. This time we have a government debt crisis. And, you know, I don't know where it's going, but the world is changing. And that crisis, which will also involve a stock market decline, uh, will induce, will create changes in the world that we've not expected, particularly government and money. So if we've had like 100 years of fiat currency and Federal Reserves and central banks printing the stuff like crazy and controlling the
Yeah.
price and quantity of money, effectively a collectivist notion of how to control money,
Hmm.
and it doesn't work, then people are going to say, well, this isn't working. Academicians will say, I kind of like the idea, but it really hasn't worked. So when you get
Right.
into this next crisis, you're going to have a lot of things change, including, I suspect, you won't even have a Fed in a year or two. Well,
Wow.
simply because, hey, it's dysfunctional. Okay. It hasn't solved any problems. In fact, you look at Fed funds rate chart, and they've been printing money since 2009. Either it's been at zero or got up to five, but even that, the interest rate level, is in the bottom quadrant of the past 75 years of rates. So it's been free money. And so the stock market went up, but it hasn't.
Right.
But once things start to break, that's when people start questioning maybe we need gold back money again. Chinese are thinking about it. I
Hmm.
think Indians are even looking at silver. When you get into this crisis, there's going to be a rethink. So when you say,
Right.
where's gold going? I don't know,
Yeah.
except it's probably going well beyond the norm. And it's probably going to do a lot of it, our assessment, and this is based on some multiple factors. A
Hmm.
lot of it's going to occur dramatically between now and summer,
Okay.
particularly in the case of silver. There's a factor that we've been watching, multiple factors that coalesce and tell us that we've entered a phase in silver similar to, or almost identical to, the surge that occurred in 79 to 80
Hmm.
and already in a bull market for multiple years, but suddenly in the final 5 months of that, silver quadrupled. Went berserk. Okay, 5 months,
Yeah.
just short of 2 quarters. And you go back and look at 2010, in September of 2010, something happened. I'll tell you what it was, technical thing. And in the next 7 months, silver doubled and a half. It was like $20. It went to 50. Okay. All of a sudden, in the latter phase of ongoing bull markets, it wasn't like a new bull
Hmm.
market. It just went
Yeah.
berserk. Okay. But both of those berserk moves were within that old half century range where silver was capped off. Gold wasn't capped off during that time, but silver was. Same
Hmm.
highs, you know. 2008, 1980 and 2011, same high, whereas gold was, way above the 1980 high. Okay. For some reason, silver was capped. Now,
Yeah.
silver just recently made a statement, said, okay, I'm going to break out of the old antique range. And I'm going to overcome the distribution by the banks. I'm in charge now. There's a reality bigger than that. And I'm going to get to the new reality. I'm going to reprice myself relative to gold more normally. It's been very repressed in price versus gold. It's been very cheap in relation to commodities. It's been very cheap so many metrics say that silver was priced off the page artificially or what. Okay, it's going to correct for that. When those spreads of silver measured versus gold, where you take an ounce of silver and divide it into an ounce of gold, what percent is silver? Well, back in that 1980 surge, where silver went berserk for 5 months, quadrupled in 5 months, the spread of silver versus gold was up at 6.5%. Okay, remember that. Then in the next price surge, still within that old antique range, 50 buck highs, 2010 and 11, the spread also broke out where you could plot silver versus gold on a chart and you could see a ceiling. And when it broke through that, in 2 quarters, silver went berserk. 7 months in this case. One was 5 months, one was 7. But basically 2 quarters, it did its thing in a tantrum. But it was still confined in that range. Silver had a more even massive technical range. If you simply don't look at the price of silver or gold, just divide one into the other and plot it each month close. You had this 10-year ceiling. You just broke through it in November. So you start with December. Okay, 1 month, 2 months. Okay, we're only 2 months into this orgy, and people are stunned by what you're seeing here. They say, "Oh my gosh, that's got to be the end of it." That clock says, give it a couple quarters. Don't assume. And silver still is only 2+% the price of gold, so it's still dirt cheap relative to gold. It's probably going to 3 to 6% the price of gold. Well, you do the math.
Yeah.
Gold only matches the prior bull market peaks of 8-fold gains and goes to 8,500, let's say. And you figure out what more than 3% of that is, or what 6.5 is. It'll put you silver up a couple hundred, 250 bucks to 500. Okay. There's some other metrics that argue for that as well. 500, for example. If you take the price chart of silver, again, you're a dumb guy. You just look at the chart on your screen, monthly price chart of silver, go back to 1975, and you see that range that it lived in for 50 years. And you break out. The orthodox analyst, quote, price chart technician, which we're not, will take the dimension of that range, which was $4 to 50, okay, didn't go to 0, okay, $4 to 50 repeatedly, and add that to the range, and you say, oh, it doubled when it got to about $95. That was the doubling of that range. Okay, I agree. But remember, gold's been moving in logarithmic scales, ratio scales, not in arithmetic. Silver's now broken out of that box price-wise and has gone beyond what you would call the normal swing objective of the dimension of the range. Okay, when you put it on a ratio scale chart, plot the thing, a logarithmic scale, you see that the dimension of that range was a tenfold from the bottom of the range, $4 to 50, back and forth. Tenfold on top of 50 is what? 500. So you want to reach the swing objective on a logarithmic scale, you're talking 500 again. That also makes some sense on the spread of silver gold. There's some other arguments for it as well, like the monetary degradation. You go back and find out where the money supply was, M2, in January of 1980. Factor in the decay in the money unit, the increase in supply, multiply, silver would be 500 bucks. So what we're arguing is technically silver is in a move to a new reality, to catch up to a suppressed reality that prevailed for way too long. And it's going to do it fast and probably overdo it to some extent in a tantrum. Markets have tantrums, both up and down. Okay.
Yeah. especially silver, right?
Well, I mean, you get a bubble stock market like the dot-com top, and look at what happened over the next 2 years where the S&P dropped 50%, but the NASDAQ 100, which is where the bubble was, the internet stocks, collapsed 82%. Okay, it more than compensated for its bubble. And markets often
Hmm.
do that. If they feel like they've been restrained in price for too long, when they catch up, they overdo it. And the same with overbought highs. They tend to overdo it on the downside. Silver's got all the excuses, fundamental, technical, and everything, to reach a new reality. And I think that new reality is largely going to be done by June, July.